Next is gain or loss on a sale of a depreciable asset. So let's use the same asset that we've been using, which is the $240,000 original cost. And what we have to do is first say, what is the sales proceeds? If we sold it, we got some money for it. And at this point, it doesn't matter if you got $1, $1,000, or $1 million. It's just what are your sales proceeds? Then you subtract the book value of assets as of the time of the sale, and that is your gain on the sale. So if someone gave you $1 million for an asset worth 100, you had a gain of $900,000. The flip side is, let's say you had net book value of 100,000, but somebody gave you 20,000 for it. So you got 20,000 in sales proceeds, but your cost is 100, so you lost $80,000. So that's why it could be a gain or loss on the sale. The tax impact is simply to take the gain or loss and multiply it times 0.4. If it is a gain, we will be paying taxes, and that would reduce the amount of proceeds we get. If we're selling at a loss, we would get a tax deduction, and that would actually give us some tax savings. So that's what we'll look at. So we're going to try, as we did previously, some examples in Excel. Is that we sell it after 4 years at the initially projected salvage price of $25,000. So that's the easy scenario. Let's just do the steps. So what are the sales proceeds? And what's the book value? The next would be the gain or loss. And then the tax effect. And then net gain or loss. Right? So that's the pattern we're going to be using. The sales proceeds is $25,000. The book value at that point of time under makers is 0. So the gain or loss in this case would be 25 minus book value is a gain of 25,000. Tax impact is plus 0.4 times that. And this is minus 0.4 times the amount of gain. So we'll pay $10,000 of tax. So net gain or loss would be the amount of money we got, sales proceeds, minus the taxes that we pay, and we'll net $15,000. So this one we want to make sure equals the sales proceeds minus tax effect. Let's be a little clear. This is the net cash flow from the sale. That's a better way to say it. Okay, so next let's sell it after 3 years rather than 4 at a price of $25,000. So here we have, we'll use the same approach. All right, so sales proceeds still 25, but now we have a book value of gain or loss is still a gain of 7,000. Tax impact is 40%. So the net after-tax cash flow is 25,000 minus the taxes and 22,113. And last is we sell it after 3 years at a price of 10,000. There. And so the sales proceeds is 10,000. The book value after year 3 is the same as the previous. So that was 17. So we lost money this year, this time, and we have a tax benefit. So just note this is a tax benefit, and it's a deduction for the loss. We have $10,000 sales proceeds, and we get, in addition, a tax benefit. So our total is $13,113. So we have to go through these calculations in order to establish what is the taxable gain or loss, and then that determines the tax impact. And to get the after-tax effect, we say what are the proceeds plus or minus the tax impact, and that's our net cash flow from that particular sale. All right, so that is gain or loss on sale of an asset.